Welcome to the deep dive. Today, we're going to go kind of beyond like the usual investing headlines. We're going to really look at strategies that have actually delivered over the last 20 years. We've got a ton of research here.
Yeah,
From, classic approaches to some you might not expect. And we're going to try to pull out the golden nuggets that are most relevant to you.
that's right. We're not just going to tell you what worked, but help you understand why and what that means for your own investment decisions going forward.
Okay, so let's get into it. This research covers a wide range: index funds, growth stocks, dividend plays, value investing, and even dips into the world of crypto and alternative investments.
And it's fascinating to see how each strategy has weathered different market conditions over 2 decades. There are some clear winners, but also some important nuances to consider depending on your individual risk tolerance and goals.
First up, the classic index fund approach. Everyone's heard of the S&P 500, right? Putting your money into an ETF that tracks this index is often called set it and forget it. But is it really that simple?
Well, the data shows that investing $10,000 in an S&P 500 ETF back in 2003 would have grown to around $67,000 today. That's pretty impressive for a relatively hands-off approach. But while it offers broad market exposure and historically steady growth, there are some potential drawbacks to keep in mind.
Like what? Most people think of index funds as like super safe.
They are generally considered low to moderate risk, but remember, they're still tied to the overall market. So if there's a major downturn, your index fund will feel it too. And while 10–12% average annual returns are fantastic, you're unlikely to see those massive gains that some individual stocks can offer.
So it's about finding that balance between steady growth and the potential for those like unicorn investments. Which brings us to growth investing, where things get really exciting. We're talking about companies expected to outperform the market, the Amazons and Teslas of the world.
Exactly. And the numbers speak for themselves. A $10,000 stake in Amazon back in 2003 would be worth well over $1 million today. But this is where things get trickier. Growth investing isn't just about picking a company with a cool product. It's about understanding their financials, their competitive landscape, and their long-term potential.
It sounds like it takes a lot more research and a higher risk tolerance than index funds.
Absolutely. Growth stocks can be incredibly volatile, and identifying the true winners is a challenge. Many investors rely on metrics like price-to-earnings ratios and revenue growth to spot companies with strong potential. But even then, there's always a chance that your pick won't live up to expectations.
Okay, so maybe growth investing is for folks who like a bit of a roller coaster ride. Now let's talk about something a bit more grounded: dividend investing. This is all about getting those regular payouts from companies that share their profits with shareholders.
Think of it as passive income while your investment grows. Companies like Johnson & Johnson are known for their consistent dividends, and the research shows that this strategy, on top of those regular payouts, has averaged an 8–10% annual return over the past 2 decades.
I've heard of people reinvesting those dividends for even faster growth. Is that something worth considering?
Absolutely. It's like a snowball effect. Those reinvested dividends buy you more shares, which in turn generate more dividends. It's a great way to accelerate your wealth building over time. But keep in mind, the company's financial health and dividend payout history are crucial factors to analyze.
Interesting. So far, we've got options for those who want to like set it and forget it, those who like high growth potential, and those who want steady income. Now let's talk about a strategy favored by the legendary Warren Buffett: value investing.
Value investing is all about finding those hidden gems, companies that are undervalued by the market. It requires some serious financial sleuthing to determine a company's intrinsic value and compare it to its current trading price.
So it's like being a financial detective searching for clues to uncover those hidden gems that everyone else has overlooked.
Exactly. You're looking for companies with strong fundamentals, solid management, and a track record of profitability, but whose stock prices might be temporarily depressed due to market sentiment or other external factors.
It sounds like you need some serious financial analysis skills for this approach. What kind of returns are we talking about for those who can pull it off?
Historically, value investing has delivered returns in the 10–15% range annually. But it takes patience. You're not looking for quick flips here. You're buying into a company you believe in and holding it for the long term, allowing it to grow and for the market to eventually recognize its true value.
So for our listeners who are thinking, okay, this is all fascinating, but how do I even get started? Where do they begin with these different approaches?
That's a great question. And it really depends on the strategy and their level of comfort. Some approaches are definitely more beginner-friendly than others. For example, investing in an S&P 500 index fund or a dividend ETF is incredibly straightforward. You can open a brokerage account online, choose your ETF, and start investing with a relatively small amount of money.
But when it comes to growth investing or value investing, there's definitely a steeper learning curve. You need to be comfortable researching companies, analyzing financial statements, and really understanding the market dynamics.
That's why it's crucial to be honest with yourself about your level of interest and expertise. If you're a beginner, diving headfirst into complex strategies might not be the best approach. Start with something manageable, like index funds, and gradually expand your knowledge and portfolio as you gain experience.
And speaking of expanding your knowledge, are there any resources you recommend for those who want to learn more about these different strategies?
Absolutely. There are tons of great resources available online and in libraries. Websites like Investopedia offer comprehensive guides and tutorials, and there are countless books written by renowned investors that can provide valuable insights.
And of course, there are always financial advisors who can offer personalized guidance, although that does come with a cost.
It's all about finding the right balance between learning independently and seeking professional advice. And don't be afraid to ask questions. There are online communities and forums where you can connect with other investors and learn from their experiences.
Okay, let's switch gears for a moment and talk about something that trips up a lot of investors: short-term versus long-term thinking. It's easy to get caught up in the excitement of market swings and make impulsive decisions, but the research really emphasizes the importance of having a long-term perspective.
That's so crucial. Investing is a marathon, not a sprint. And just like with a marathon, you need a plan and the discipline to stick to it even when things get tough.
So, how can our listeners develop that long-term mindset and avoid getting sidetracked by those short-term market fluctuations?
It all starts with setting clear financial goals and a realistic timeline. Are you saving for retirement, a down payment on a house, or your child's education? Having those goals in mind can provide a sense of purpose and help you stay focused, even when the market gets bumpy.
It's like having a destination in mind when you set out on a road trip. You might encounter detours and delays along the way, but knowing where you're headed helps you stay on track.
Exactly. And just like with a road trip, it's helpful to have a map or a guide to help you navigate. That's where your investment plan comes in. It outlines your strategy, your risk tolerance, and your time horizon, guiding your decisions along the way.